All right. So we're going to start this conversation about the income statement. Now, if we think back to kind of how this class began, right? We started with chapters 1, 2, and 3, kind of giving you the building blocks and an overview of the entire accounting cycle, right? We talked about the 4 financial statements, balance sheet, income statement, statement of retained earnings, statement of cash flow. And then we talked about how to create transactions, debits and credits. And then we got fancy and talked about recording and adjusting journal entries. We can make sure that everything is on the accrual basis of accounting, getting to our adjusted trial balance, which then feeds to our financial statements. So that was all chapters 1, 2, and 3. And we talked about how to close the books so that we could start it all over again. And then what we did, in starting with chapter 4 all the way through chapter 10, is we start walking down the balance sheet, right? So we talked about cash, and then we talked about short-term investments. We talked about accounts receivable and inventory, and you took a test. And then we talked about long-term assets like equipment, and then we talked about long-term investments. And then we got to chapter 8 and 9, we talked about short-term and long-term liabilities. And then we talked about, in chapter 10, equity and the different components of equity. We even talked about the statement of owner's equity, right? So over the past, 14 weeks, we spent a lot of time talking about the balance sheet, and we spent the class period talking about the statement of owner's equity or statement of retained earnings. But I would suggest that the most important statement is the income statement, which then your response should be, hey man, if you think the income statement is so important, why you wait until the very end of the class to tell us about this thing, right? And then, so I'm having this whole conversation by myself, and I respond back and I say, because as we were talking about the balance sheet, we were also talking about different components of the income statement. Because remember, every transaction affects at least 2 accounts. So I like to call these accounts cousins, right? The accounts on the balance sheet and the income statement. For example, when we're in there talking about long-term assets, we're talking about equipment and vehicles and buildings. We're also talking about depreciation expense on the income statement and accumulated depreciation. So by talking about equipment and accumulated depreciation, we talked about the depreciation expense. Okay? When we were in chapter 5, we were talking about accounts receivable. Well, when you debit accounts receivable, what do you credit? Everyone says revenue, right? We credit revenue. So by talking about accounts receivable, we're talking about revenue. We talked about those accounts receivables that won't be collected. We talked about crediting that contra asset account, allowance for doubtful accounts, but we talked about debiting bad debt expense. So whether you realized it or not, as we've been going through this class, we've been talking about both the balance sheet and the income statement. So really, there isn't much we have to talk about in terms of new things, right? But there's definitely a lot of things that we can refresh and make sure we remember how that works. So there's thinking, what do we already know about the income statement? Okay. So the income statement starts with what? What's at the very top?
Revenue.
Thank you. So you got your revenue, and then you got your expenses, got your gains, and then you've got your losses, and that equals your net income. Right, so we already know that. Those are kind of like the 5 components on the income statement. We also know that expenses break down into cost of goods sold, right, and other operating expenses. Right? So, and we know that we can take the income statement and break it down into different components, right? So we can have your gross margin, which is your revenue less your cost of goods sold. You can have your operating income, which is your gross margin less your operating expenses. And then you can have your income before income taxes, which would be your operating income plus any non-operating income minus any non-operating expenses. Non-operating income is our gains, right? We talked about gains on sale of assets. We talked about unrealized gains on trading securities, and talked about gain on equity investments. And non-operating expenses are losses. That would be your loss on impairment of assets, unrealized loss or realized loss on investments with insignificant influence, things like that. And then your net income is your income before taxes minus your income taxes. So we pause there and see what questions you all have. If this is starting to fuse in your minds.
You said that non-operating expenses could be losses or unrealized losses?
Yes, it's realized and unrealized losses.
Okay.
What other questions do you have?
That would make non-operating income just gains.
Yes. Realized and unrealized gains. All right, let me remind you of one more thing, okay? And then I'm going to tear you guys loose to play. In math, what does 1 plus 1 plus 1 equal?
3.
It does. Is this math? No.
Nope.
This is accounting. In accounting, right, if we have operating income of 1,000 plus 1,000 in non-operating income plus 1,000 in non-operating losses, what would be the answer there?
1,000.
Uh-huh.
1,000.
Right. So being mindful of the language, right? Remember, accounting is the language of business, right? The math part's the easy part. You guys are like, hey, just tell me what numbers to put there, and I'll put the numbers there. So the math is the easy part, but it's knowing how to interpret this. So we're gonna play a game. Man, we used to play this game in class, and obviously can't do that. We're gonna try this one, all right? So let's see if I can find it here. If you log into your Canvas account, I'm going to share my screen so you can see it. Where are you at, Canvas? Okay. So let me, so student view. Let me look at it from your perspective. Oh, leave. You guys are probably already there. Sorry. All right, student view. So if you go right here, you should see an income statement puzzle. Okay. I want you to click that. This is a little bit of a game to play here. Should take you to this website. So you're going to have 10 minutes, and you have 8 tries, okay, to match up the revenues, cost of goods sold, operating expenses, non-operating gains and losses, and net income to the correct company. Okay. So you got 3 companies. You've got Benjamin's Bicycles, and you've got Lucas's Lemon Bars and Bakery, and you have Mackay's
Alliteration.
All right, so go ahead and click start, and good luck. Yeah.
I would take the lowest numbers for like the bakery and stuff and try to do it that way, like because bicycles obviously cost more than. Yeah, but it doesn't. It's not logic though, because it has nothing to do with how much those items cost. It has to do with how much they made over a certain period of time. So it just, like you could make 30 grand in a month off of like bakery stuff and only 15 on bicycles in a month. So it just is not. It's not
Do
logic.
the same thing, and I figured that out too.
So yeah, you're right. I think initially you have to make a guess as to who's which revenue goes where. So here are the answers, which I'm sure you guys saw after your unsuccessful attempt. Revenue to the 50,000. Then cost of goods sold, which is the total cost of creating or selling with Benjamin's 50,000. And the hint here tells you if gross margin is 30,000, right? And your cost of goods sold is 20, 30 plus 20 has to equal 50,000. And again, once you know this hint, you can start looking at hints now to match things up. The hint says that operating income is 16. If your operating expenses are 14, right? 16 plus 14 would be 30,000. So that's how you know it matches to Benjamin's gross margin or Makai's gross margin. When we get here, we'll just stick with Benjamin. Non-operating income or loss suggests that it's a loss. Okay. So this $15,000 is a loss that would get your income before income tax to $1,000. 1,000 plus 15 would be 16. Which gets us back to Benjamin's income, 16,000. I want you to compare it with Makai's, right? No parentheses means it's income. And the income before taxes is 20,000. So here you would take the 20 and you'd subtract from that the 7, right? Because if you're trying to figure out if the income before taxes is 20, income must be 13,000, which would be right here. Questions?
Not worth 100 points like Kansas.
No. It was worth points of fun.
Okay.
Or
Yeah.
frustration. Whichever F word you want to use.
That's totally okay.
Sorry, what'd you say?
We would appreciate that.
Wait,
I said if you want to just give us those 100 points, that'd be cool. You know.
I can give you 1,000 points. Tell me how many points you guys want. I'll give it to you. But just keep in mind that after I give you the 1,000 points, I'm going to adjust the grading scale appropriately.
That's understandable.
You know, make it out of, offer up 1 million points for this class. All right, let's get back to it. Oh, cancel that. Stop. This is where I want to go. So I want to take a look at Apple's income statement. Okay. And this is the income statement from their last fiscal year end. So the 12 months ended September 28th, 2019. Okay. Now, first thing I want to point out is call it income statement. Most companies do, they call it the statement of operations. And here's why. You can't have an income statement if you have a loss, right? It'd be a loss statement. And no company wants to call their financial statement a loss statement. So they just use this general term statement of operations. You can also see that it is solid, right? About NXE, but it's consolidated. When they say
It's accounting for all the companies it owns as well.
it's accounting for all the companies that have a controlling interest, right? Generally something more than 50%. So embedded in products, right, would be companies where they own, say, 60% of that company. So they'd be taking 60% of their revenues, 60% of their expenses, etc. Remember we talked about the income statement is reported over a period of time. So you can see here at the top, 12 months ended, right? So starting from September 30th of 2018 all the way to September 28th of 2019. And they're also did, what would that be? Somewhere in July something to September 28th of 2019. Okay. And then the other thing, this is all financial statements do this, they show information on a comparative basis, and then showing you a comparison here. Same thing for the 12 months here, a comparison here. Real quick, does anyone know when Apple's fiscal year end is?
September.
I'm sorry?
September.
September? It's not September 30th because for 29th, and here they're showing September 28th. Anybody know?
September 29th.
So for Apple, their fiscal year end is the last Saturday of September. Isn't that crazy? So they just say on the last Saturday of September, that's when we're going to close. So when you look at comparative, you're always going to see different dates on there because they're just taking that last Saturday in September. And then you can see here, right, those 5 components you're going to find on an income statement. Revenue, what they call net sales, minus cost of sales is their gross margin. And then you've got their operating expenses. Okay. So gross margin minus your operating expenses gets you to, this is their non-operating expenses. gains and losses, right? And they don't show those separately. They just take all the gains number, okay? And then your operating income plus your non-operating income, you're going to see there. And we're back. And the last thing that you're going to see there is the income tax before tax, or income before income taxes minus the income tax, okay, of and this is all in millions, right? So this is $2 billion in income tax expense just for those 3 months to get to your net income. So we're going to start walking through these, right, and kind of do a review. But first, happy to answer any just general questions. So let me reiterate, we're not learning anything new, right? We're reviewing things that we already have learned. And so actually, I guess we are learning things new because you're going to learn it more deeply. You're going to learn it better. Okay? But really take this as an op. Don't sit here like thinking what's going to be on the test. But think about this now as, I mean, shoot, guys, ST's website, this is for you. You understand this language. So ask questions and let's engage in some good dialogue. Right, let's talk about their revenue. So revenue is income earned from the company's core business, okay, or needs for doing what they said they were going to do. Right. Now, to record, you can see here that they're reporting revenue as in 2 different broad categories: products, services. And so products would be the iPad, the MacBook, the iPhone, right? The Beat headphones, whatever else they have their hands in. The services would be things like Apple Care, Apple Music, Apple TV, not the device, but the subscription you have to pay for. $3 or something for like terabyte iCloud space. So those are the services there. But in order to recognize revenue, so I guess the question is, when can Apple say we made revenue? We earned
When they
revenue.
did what they said they were going to do.
That's exactly it. When you get to record revenue. Can you guys see my screen? Yeah, you can, I think. So let's talk about that, right? Because I just gave you guys like the simplest term possible, right? But actually, in accounting, there's 5 steps. It's way too big. There's 5 steps that a company has to achieve in order to say they can recognize revenue. And by recognize revenue, we're saying debit accounts receivable, credit revenue. Okay. Or we're saying debit cash, credit revenue. Or we could be saying debit deferred revenue, unearned revenue, hello chapter 3, credit revenue. Okay. So in all instances, when can they say we've earned revenue? 5 things. Number 1, first they have to identify the contract. Oh, by the way, this is all new accounting stuff. This new Rev Rec came out, revenue recognition came out, I want to say in 2017, And I told you guys, accounting doesn't really change, right? The depreciation that we're doing in Chapter 7 is the depreciation I learned like 25 years ago in college. So the stuff ain't really changing. But when it changes, like this is like, I know you're saying, well, this guy's a nerd. Okay. Yeah, and I'm excited about this. All right, number 2, identify the contract. You have to identify the performance obligations. Let me just tell you a little bit why the rules have changed, right? 25 years ago, companies did like, they sold you something and then you owned it, right? So I'm going to sell you this TV, and then once I sell you the TV, then you own the TV and you can use it for as long as you can, right? But now things changed, right? Because we have these things called Apple TV. I'm going to sell you this hardware, but what I'm really going to sell you is a subscription, right, that you have to continuously pay for. Everyone's has moved to this subscription-based model. So software has become more and more important in our world, right? And how it makes the product run. People realize I'm not really buying necessarily this device. What I'm buying is, you can see that? I'm not buying this device, I'm buying the software that makes this device run. Okay? And not only am I just buying the software that makes it run, also buying the right to get updates to the software. So when they need to make a security change, or they come out with a new iOS platform, we're going to get those updates for free. So all that's part of this performance obligation. Number 3, we have to figure out what's the amount of consideration, and what's the price for this entire contract.
But you're coloring.
I'm not coloring, I'm in class. So what's the amount of this total for everything that we're offering? How much are we going to charge for that? Okay. Number 4 is we then have to take that amount and allocate allocate's just a fancy word for separate. Isn't that right, Lucas? Separate the price to the performance obligations.
But look at this. Look at this.
Yeah, you like that?
Yeah. And I want to color. I want to color. It's so cool. I want around.
All right, and then number 5, this is when we do what we said we're going to do, right? We're going to recognize revenue, okay? This part right here. We get to recognize revenue when the party satisfies its obligations. Okay? Or in other words, when they do what they said they're going to do. Okay? So I've just been talking about this part right here. But when you're selling something like a phone or a device, right? I buy this phone. When I bought the phone, not only did I buy the phone, but in order to get this phone from Verizon, I had to buy a 2-year service plan, right? So I had to agree that I was going to use this phone for 2 years, right? Or pay a cost for it. Also may have bought an extended warranty on it, right? And so again, that's an additional cost or additional obligation that Verizon has made to me. Okay. When I bought this phone, I bought the right to get updates when they become available, or upgrades when they become, or updates when they become available, software updates, right? So there's all these different components embedded in that purchase. Okay. And so what Verizon has to figure out is when Eric went in and said he was going to agree to pay $100 a month, okay, $100 per month for the next 2 years. Okay. what did we promise to give him? Okay. We promised to give him a phone. We promised to give him service. We promised to give him Apple or care or warranty. Okay. And let's say they also threw in like free Apple TV for a year or something like that. So they have to identify all these different performance obligations and then find a way to say, okay, if it's 22 years, $100 a month, the total price is $2,400. How do we break that out, that $2,400, into all these different components? And then after they break it out into separate components, as they're satisfying their obligations, right? We gave them the phone. That's an iPhone. We gave them the phone. I've had this phone for like 3 or 4 years now, so I'm super proud of myself. We gave them the phone, so let's recognize the revenue.
Warning. Excavator Omicron will cause decompression of tunnel 11.
All right.
Hey, Mr. Bell, real
Thank you.
quick, Deontay wanted me to let you know that his whole internet Wi-Fi thing crashed and he got pulled out of the Zoom class. But yeah.
Okay. And then as they're providing me a service, right, every month they're making a journal entry. As they're providing me the care, whether I use it or not, right, they promise me 2 years of care. So every month they get to take a piece of that, right? That's that unearned revenue piece that's being recognized. Is this making sense? I'm going to pause and let you all ask questions.
This last one you're talking about is number 4, right? Where you separate, so you're not all lumped
Yeah.
into one entry.
Yes.
Okay.
Yeah. So let me apologize. I think I just went way too deep. I was just excited about this. Here's Apple's. Let me just show you how Apple describes their revenue recognition policy. So I just pulled this up on the internet, and it says, so this is not Verizon, right? This is Apple. The company has identified up to 3 performance obligations regularly included in arrangements involving the sale of iPhones, Macs, iPads, certain other products. Think about the language that they're using, right? And how this is going back to the accounting aspect of it. The first performance obligation, which is a big part of the substantial portion, big part of the sales price, is the hardware, the iPhone, and the bundled software delivered at the time of the sale. So in other words, as soon as we deliver it, most of the revenue from this arrangement, we're earning that. We're saying we earned that. We did what we said we're going to do. The second performance obligation is the right to receive certain product-related bundle services, iCloud, Siri, Maps. Okay, so I didn't realize this, but there's I should probably use my Siri more often, but they're considering that as a product that they're providing to me, right, separately. So every month they get to recognize more revenue because apparently I bought Siri. Wish I could have taken that off the contract. The third obligation is the right to receive, when and if available, future unspecified software upgrades related to the software bundle.
Excavator Omicron. Control restored.
All right, someone can go on mute. That's the upgrades that we get to our phone. Revenue allocated to the product-related bundle services is deferred, right? Create the liability and recognized on a straight line basis, okay, over the estimated period they're expected to be provided. We're recording revenue when we do what we said we're going to do, expected to be provided. I just went down a serious rabbit hole, guys. But I did that because I want you guys to know that there's like so much more depth to this accounting thing, right? But we just need to understand that revenue is income earned from the company's primary source of business, and you can record the revenue, credit revenue, when you do what you said you're going to do. You don't have to memorize those 5 different revenue recognition steps, okay? But they're there. So let's see here. They're saying, oh, let me say one more thing about those 5 steps though. Revenue recognized when the party satisfies its obligations. One of the considerations that they have is when can Apple say, right? We saw that they said as soon as they ship something, the product, right? That's a big part of their sell price. So when can they record this journal entry here? This journal entry right here. Let's say it's cash revenue. Can they record it when we order it online? Can they record it when it's shipped? Or can they record it when we receive it?
It depends on their policy.
Wait,
Depends on their policy.
you saying there's an FOB?
Didn't we just say their policy was shipped?
Didn't we say what? Go ahead, Romina, what did you say?
Didn't we just talk about how their policy was shipped, or did I miss that?
I don't think we looked at what their policy
The actual policy
was, or in terms of when they record when they record it, ordered, shipped, or received. And Evan, what were you saying?
I was about to say, are you implying that there's FOB order, or what is the order?
Oh, I'm not implying that. So
okay.
We know that's not it. Is it shipped or received? How do we? And Jasmine said it depends on the policy. Which policy?
Their revenue recognition policy.
Yeah, but the specific part within that rev rec policy. Anybody? Got to go back to like chapter 5. Then we talked about it again in chapter 6.
It's when the ownership of the product transfers.
When it transfers title, yeah. And we call that FOB.
Freight on board?
Shipping or destination?
FOB shipping point and FOB destination. Yes. When it's FOB shipping point, right? If they're recognizing revenue under FOB shipping point, as soon as they ship it, they say we've earned the revenue. Okay. If they're waiting for us to receive the product, FOB destination, then once we receive the product, that's when they record this. So I've already, in the last month and a half since we've been sheltering in place, I bought 2 Apple TVs, one for my parents and one for my in-laws. And so when I ordered it, that's not when they get to recognize the revenue, right? And then they shipped it, that's probably not when they recognize the revenue. They had to wait until there was confirmation that I received it, right? When that FedEx truck or whatever scans it, the box, and then drops it on my front door, that's when they can say, all right, now we can recognize the revenue. Debit the cash, right? Because I paid with a credit card, so they're going to get their money immediately. Credit the revenue for the bulk of that $150, whatever it costs, right? Because we did what we said we're going to do. Sure, if there's updates and things like that, we'll recognize that as well. When we get back to, going back to this one here, this all represents stuff where they've, under FOB destination, the customer has received it, right? Or under FOB shipping point, like when there's FOB shipping point is probably when they're selling to like another company or selling to a school district or something like that. Once we ship it, they recognize the revenue. The other word here I want to point out is this word net. Net, total net sales. What is that net of? So net means the difference, right? We get our gross payroll, gross paycheck, and then our net pay. That means they took something out. So what's been taken out of sales?
Taxes, what you would pay in taxes.
Good guess, but no, taxes would be all the way down here under income taxes.
The shipping fees.
Shipping fees, good guess, but no, shipping fees are actually down here. If Apple's paying the shipping fees to sell something under selling, general, and administrative.
How about cost of goods sold?
Good guess, but no, cost of goods sold is right over here.
Allowance for doubtful accounts.
That would be down here.
Is it interest?
What about? No, interest. These are great. Oh my God. No, interest is down here.
Credit card
I'm loving
fees.
this conversation. Credit card fees. I think it's down here. Here, I'll show you. I'm doing way too much switching between iPads and my internet's just gonna die on me. So we have revenue, and then we have sales discounts, we have sales returns and allowances. And then we have our net revenue. So what do we call these accounts? What type of accounts are these?
Contra revenue.
Yes. Contra revenue. Everything else you guys are describing were expenses, right, which gets recorded below revenue. But what Apple's saying is our sales are net of any sales discounts we've given, any sales returns that we've had. Someone buys something and they return it. We had a sale and we discounted our off our normal sale price. Okay, so that would show up under net revenue. Questions? I would argue that the most important number in a company's financial statements is this number right here. 260 billion, this is in millions, $260 billion. Okay. Revenue, in my opinion, is the most important number because it tells you, is the company good at doing what they do? Okay. How good are you at doing what you do? And Apple is pretty doggone good, $260 billion. When we describe companies, we talk about them in the context of their revenue, right? It'd say Apple's a $260 billion company, not a $55 billion company, right? Not this net income number down here. It's this top line number, because everything that you add here is flowing down to make this a bigger number, right? So everything is focused on revenue. If I could just switch gears real quick and talk about from an auditing perspective, right? So the independent accountants who come in and we make sure that Apple or whatever company has done their financial statements correct. There's rules that we have to follow, generally accepted auditing standards, right? The rules that we have to follow. And one of those rules says that we have to consider the risk that fraud has happened, right? So as we're going in and testing numbers and doing these tests, we have to consider the risk that fraud has happened. And within that consideration, they say there's two things that you have to look at. One of them is they say you have to just assume that there's fraud in revenue. So when an auditor, Ernst & Young is EY's auditors, when Ernst & Young goes in and says, okay, let's test to make sure that there was actually $260 billion, they have to go in under the assumption you committed fraud. You lied to me, right? They have to bake into their testing procedures this concept that they committed fraud with revenue. The other one is journal entries. But that's how important this revenue number is. Questions?
Wait, Professor. What if for a business, as their revenue increases, their losses increase? So would revenue still be the most important number?
I think so. Are you thinking of Tesla?
I was thinking of Wayfair, actually.
Okay, I'm not sure. I think I've heard of the brand, but what does Wayfair do?
Online furniture.
Okay. Yes, revenue. I would still see revenue as the top line number, because what they're doing is they're building out their infrastructure, right? And as you're building out your infrastructure, it's going to cost you a lot of money to build that infrastructure. But the more and more revenue that you can earn, it's going to cover all those costs, as well as produce a profit at the bottom, right? At the end. So people are still focused on that revenue number, not so much the cost, because they say, hey, these costs are all part of growing, right? Wayfair can really say, we just want to service the Bay Area. We just want to service Livermore. So therefore, they can significantly decrease their infrastructure costs and just service Livermore, right? And be successful in that regard by just managing their revenues. Other questions? All right, so let's do so here's Chewbacca, social distancing, Target. Someone asked me on the break what my favorite Star Wars character was, and I put Chewbacca up there. So we're going to do an example for the next couple weeks. We're going to use a fictitious company called the Star Wars Toy Store. They're a toy store that sells Star Wars collectibles. All right, so here's your question. I'll ask you two questions, and I'll let you guys go back into your breakout rooms to work on these questions. Okay? And then once you have the answers, you can invite me into your breakout room. I'll answer them, or make sure you got it right. And then once you got it right, we can call it a day for now. So here's so you should probably take a picture of the screen. So when you go to your breakout room, you have it. And if you think that another one of your team members is going to do it, they're probably not. So maybe you should be the responsible one to take a screenshot. So here are the two questions. For the first one, what should the Star Wars toy store reflect in its 2017 income statement for this sale? Okay, the sale was on December 23rd of 2017. They sold a truckload of toys to a store in Amarillo, Texas. and the terms are FOB destination, but the truck ran into bad weather, so it didn't arrive until January 2nd. So their year ended December 31st, and it was $126,000. Second question, suppose that when the store personnel in Amarillo, Texas, opened the shipment, they found that there were $5,000 of damaged toys, and they notified the Star Wars toy store of the problem, and then they returned the damaged toys. So what entry would the Star Wars toy store make for this transaction? Okay. So you guys can go back into your breakout rooms. You should still have access to that. Let's see. Yep. So you guys can go back into your breakout rooms. Oh, let me open all the rooms again. There you go. You're able to go back into your breakout room. Chris, remind me what group you were in. I think 1. Am I right?
What was that?
What breakout room were you in?
I was with Madison and her group. Sorry, I had to.
All right.
My internet went down for like 20 minutes, so I had to reboot it.
Not a problem, my friend.
Can you go back to the revenue question real fast?
Yeah, is that not what you're seeing right now?
No, I'm seeing the leases from the test.
Oh,